The market has become decidedly negative and has broken 4,000 on the S&P 500 since the first for the first time since April of 2021. However, credit card spending since April of 2021 is up 13% year on year. I don't see any sort of current economic indicators that suggest that we should be having this major pullback. What can justify this kind of pullback is a rise in rates. Rates affect the price of stock valuations. However, that seems to have overshot a bit, both on the rate side and on the stock market reaction side. Why do I say that's overshot? Well, if you hear what the Fed members are saying, and let's not forget, the Fed is the reason why rates are rising, their commentary does not suggest further increase from here, at least substantially. And we saw a movement like that in the bond market. Today, the 10-year got up as high as 3.2%, pulled back and broke through 3.07%. That's quite a substantial move in bond yields in the bond market. What are the Fed governors saying? Well, the two most hawkish Fed governors, Jim Bullard and Christopher Waller, they're saying the bond market is pricing in the moves in yields, their forecast. And let's not forget, this isn't a middle dovish to hawkish person. These are the two very most hawkish people saying, in terms of their expectations, their forecast, that the market is largely already pricing in most of their forecast and expectations. There's a bunch of competing forces here that you have to weigh and see how they compete. We'll talk about one right now. The economy, because that seems to be a big negative on the market. And if you're worried about the economy, you're worried about the market. If the economy faces trouble, then the Fed members can't be maximum hawkish. We can't go to where Bullard and Waller want us to go. We have to go more to where Powell wants us to go. I'm saying I'm not seeing any problem with the economy, so I don't think that matters. But I think, let's go with them. Rates are pricing in a whole lot. Let's chill. And I think we have to chill. But I don't think the market is ready to chill until it sees hardcore signs that inflation is truly stopping. It seems to me like a lot has to do with that. That's been why rates haven't been able to chill, why they've had such an aggressive rally here. You get the Fed clamoring about inflation. You get rates following, inflation following, et cetera, et cetera, et cetera. Causing a lot of turmoil, stress, and pressure on everything, on all assets. I'm seeing a couple signs that these fears and these pressures can begin to abate. The first one happened last week with the Manheim Used Car Index. At one point, used cars accounted for 1/3 of the CPI increase. They're now beginning to roll over. That's an optimistic sign for CPI. We're seeing the same with copper, aluminum, lumber. We saw a big drop in oil today. I don't know if that's going to persist, but I don't think oil goes to $300 a barrel. Things might be calming down on the price front. We were, inflation bulls before. We've been playing energy. We've been playing mining materials companies, et cetera, et cetera, et cetera. We've been talking about that for over a year now. It seems like that might be calming down. The Fed might get things under control rather quickly. And if that's the case, the market can absolutely chill. Because like I said, April, 13% year-on-year spending increase. And travel is up like some 60%. So people aren't, strapping the belt. That's not people going to the grocery store and spending more money. They're spending 60% more on travel. And April is kind of when you set your summer vacation plans. Or not, 60% more. That's like massive. So I'm not concerned about the economy, at least not yet. Sure, maybe in a year from now, something happens, things are different. I wouldn't be surprised. We've had such strong growth. I don't think we can keep it up. But as of right now, we are keeping it up. So I don't see any reason to panic yet. Obviously, we want to be ahead of the curve, but I'm not panicking yet. I'll let others do the panicking, and I'll be greedy when others are fearful if the fundamentals make sense. And I think they are making sense. So, my opinion, data I'm seeing right now, economy is strong. That is one thing. We're seeing one thing that's positive for inflation. We're seeing prices thus far roll over. We get the CPI report on Wednesday. Maybe that can provide a market bottom. We're hoping, and we'll see what happens. Anyways, there's another one that is also important. So this morning, Fed member Kashkari cited the supply chain as needing to provide some assistance to get inflation down. The Fed can't do it all on its own, needs the supply chain to pick up. We obviously see China lockdowns, so that is a little bit of a concern, but hopefully those will lift soon. Anyways, Fed member Bostic, later in the day on a Twitter space, which I was listening to, said that he is seeing signs that the supply chain is starting to ease up. Now you've got commodity prices starting to roll over. You've got used car prices starting to roll over. Maybe you get supply chains starting to fix themselves. You've got a strong labor market. You've got spending up year on year. Rates are pricing in the entire Fed. And you've got a stock market down 20%, with more stocks down 75% and 90% than were down in the March 2020 crash. You have ARK at March 2020 lows. Disney below, 2019 levels. In my opinion, this is setting up for a reasonable bottom and a tremendous buying opportunity. So I am very much in the be greedy when others are fearful camp. I'm looking at the fundamentals, and I think the fundamentals and the stars align here. I'm not really concerned. Obviously, I have no idea where the market volatility is going to take us short term. I have no idea. I am not a pro at that. I am not some technical analyst guru. I don't think any of them bat 1,000. I always think they have good hits and good misses, and they're just like the rest of us. So I focus on emotional stability and fundamentals. And when I have emotional stability and focus on the fundamentals, I happen to see quite a tremendous opportunity here. At least I don't see tremendous downside. I don't think this is an 08-09 situation. There's not some, massive financial system fault here. It's not happening. Inflation is not a financial system fault. Yeah, valuations got expensive, but like I said, the only time stocks have been down more, 75 and 90%, were in the 08-09 crisis and the dot-com bubble. There's a difference, and they're almost the peaks of those, by the way. The reason why I don't think this is the dot-com bubble is because if you look at S&P 500 earnings and big tech earnings, they're significantly more mature and material than they were in the dot-com bubble. Then we didn't have companies making tremendous amounts of money. And we do now. And if you look, a lot of people say, oh, the market's gotten so high, so we have to have this big drawdown. That only makes sense if you don't look at S&P 500 earnings, and you don't look at Apple earnings, and you don't look at Microsoft earnings. If you look at those companies' earnings and their revenues, you'll see actually the cash flow is in line with the stock chart. It's not tremendously, discoordinated or anything like that. So we have that. We have sound economic fundamentals, 13% year on year, April credit card spending increases. We still have tremendous consumer balance sheets. We still have tremendous corporate balance sheets. We're still putting good earnings. Yes, companies are decreasing guidance. I think that's an okay thing. I don't think any of them are saying that they expect an economic slowdown. It seems to me that they're hedging for uncertainty. GM and Ford, they're not doing anything about their guidance. They both beat earnings. They were both up the next day. That's GM and Ford. Remember what happened in the 08-09 crisis? Those companies went bankrupt. Ford didn't go bankrupt, but GM went bankrupt. Ford almost went bankrupt. So they're not worried. They're not concerned. They're still lending to consumers. And I think things are okay. I think this is a be greedy when others are fearful moment. And I certainly am. I'm not in this uber pessimistic batch. So that's today's video. And until next time, peace out.